Find out every detail about the peak margin requirements to conduct successful intraday trading. Peak margin is the maximum margin that brokers collect from their clients for placing any intraday or delivery order in the cash and derivatives segment. Generally, the clearing corporations take snapshots of all margins roughly 4 times a day. The highest margin requirement from these 4 snapshots will be the peak margin. Peak margin helps to curb the excessive leverage for intraday and derivatives positions. Peak margin is evaluated by the norms issued via a SEBI circular dated 20th July 2020. The clearing corporations take snapshots 4 times a day from 9 a.m. to 4 p.m. The highest margin noted is taken to be the peak margin. So, let's assume that you have 500 shares. You sell them at 10 a.m. and 11:30 a.m. in 2 tranches. The selling happens with sufficient upfront margin thanks to the early pay-in of shares. However, the price of shares falls. Now you wish to repurchase the 500 shares at around 2 p.m. and 3 p.m. in 2 tranches, just as you sold them. Since you sold 500 and are buying back the same, the net obligation is 0. Nevertheless, while determining the peak margin, the clearing corporation will take the highest snapshot received of those shares from 9 a.m. to 4 p.m. The capital market regulator changed the margin system through 4 distinct phases, starting from 1st December 2020. Phase 1. In this phase, the client needs to make at least 25% of the peak margin available to the broker. It would then be compared with the respective peak margin available with the trading member or clearing member during the trading session. However, the second and third phases witnessed the peak margin requirements increase to 50% and 75% of client obligations with the broker, respectively. Currently, the third phase is operational. Following the fourth phase, 1st September 2021, the peak margin requirement will be increased to 100%. Brokers failing to adhere to the new system will be fined. The present phase of the peak margin that has been in effect since 1st June 2021 will continue till the end of August 2021 and will occur a penalty on the part of the investors if the margin block is less than 75% of the minimum margin required. On the other hand, the allowed intraday leverage for the cash and derivatives segments is capped at 6.67 times and 1.25 times respectively. However, the equity cash delivery or F&O overnight margins remain unchanged. Furthermore, upfront margins should be provided in funds or securities to execute any transactions in the cash and derivatives segment wherever applicable. Earlier, the calculation took place at the end of the day. Hence, it was possible for an investor or trader to buy securities at the sale value soon after selling shares based on the available margin. However, under the new mechanism, margin requirements are calculated during the session. Therefore, there's a reduction in funds available for post-sale new share purchase. The new peak margin mechanism embodies SEBI's mantra of leverage only to the extent palpable by an individual and/or entity. As a result, it would neutralize the brokers who offer ever-increasing multipliers to counter SEBI's raising margins and contract sizes. The margin shortfall penalty structure has 2 slabs. First, when the short collection for each client is less than Rs 1 lakh and less than 10% of the applicable margin, the penalty will be 0.5%. However, if the short collection for clients is more than or equal to Rs 1 lakh and more than or equal to the margin, the penalty will be 1%. Early paying EPN helps reduce several hassles and utilizes margins more efficiently. It is an early pointer that would finally result in moving the settlement cycle to T+1. The current mechanism is an endeavor by SEBI to fast forward this process. SEBI introduced new regulations to curb speculative trading and bar brokers from offering their clients 10x, 20x and 30x margins. Furthermore, the new peak margin mechanism also helps create an equal and fair playing field across broking interfaces by reducing the excess speculations and the risks involved in leverage. Trading on leveraged funds may not be the wise thing to do, especially during the highly volatile trading session. Excess leverage can wipe off the holdings. Hence, the new mechanism is designed to strengthen trading activity and guard the overall safety of the market.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.